Transfer pricing is a concept used in business and finance that refers to the prices set for goods, services, or intangible assets exchanged between related entities within the same organization. For example, when a company with branches in different countries sells products from one branch to another, the price they set is the transfer price. This practice is crucial for multinational companies because it affects how profits are reported and taxed in different countries. Understanding transfer pricing helps businesses comply with tax laws and avoid penalties. In this video, we'll break down the basics, explore why it matters, and look at how it works in real-world situations. Transfer pricing matters because it directly impacts how much tax a company pays in each country where it operates. Governments want to make sure that companies don't manipulate prices to shift profits to low-tax countries, which would reduce their tax bills. By setting fair transfer prices, companies can avoid legal trouble and maintain good relationships with tax authorities. This is especially important for large multinational corporations, as their operations often span many countries with different tax laws. Proper transfer pricing ensures transparency and fairness in global business. Key concept in transfer pricing is the arm's length principle. This principle states that the price charged between related parties should be the same as if the transaction were between unrelated independent parties. In other words, companies should set prices as if they were dealing with an outside business, not their own branch. Tax authorities around the world use this principle to check if transfer prices are fair and reasonable. Following the arm's length principle helps companies avoid disputes and penalties. Let's look at how transfer pricing works in practice. Imagine a company with a factory in country A and a sales office in country B. The factory makes products and sells them to the sales office. The price set for these products is the transfer price. If the company sets a low price, more profit shows up in country B. If the price is high, more profit is reported in country A. The transfer price affects how much tax the company pays in each country, so it's important to set it correctly. Transfer pricing doesn't just apply to physical goods. It also covers services, intellectual property, and even loans between related companies. For example, a company might provide management services or license a trademark to another branch. Each of these transactions needs a fair transfer price. Setting appropriate prices for all types of transactions ensures that profits are allocated correctly and that the company stays compliant with tax law. There are several methods companies can use to set transfer prices. The most common methods include the comparable uncontrolled price (CUP) method, the resale price method, and the cost plus method. Each method has its own rules and is chosen based on the type of transaction and available data. The goal is always to find a price that reflects what independent companies would agree on. Choosing the right method is crucial for accurate and fair transfer pricing. Comparable uncontrolled price (CUP) method compares the price charged in a controlled transaction to the price charged in a similar transaction between independent parties. If a company sells a product to both its own branch and an unrelated company, the price charged to the unrelated company can be used as a benchmark. This method works best when there are reliable market prices for the goods or services being transferred. Resale price method starts with the price at which a product is sold to an independent customer. The company then subtracts a normal profit margin to arrive at the transfer price. This method is often used when a sales branch simply resells products it buys from another branch without adding much value. It's a straightforward way to set prices when market resale prices are available. Cost plus method calculates the transfer price by adding a standard profit margin to the costs incurred by the supplying branch. This method is useful when one branch provides goods or services to another and there aren't many comparable market prices. It's commonly used for manufacturing or service transactions within a company. The key is to use a reasonable profit margin based on industry standards. Besides the main methods, there are other approaches like the transactional net margin method, TNMM, and the profit split method. These methods are used when it's hard to find comparable market prices or when transactions are complex. The TNMM looks at net profit margins, while the profit split method divides profits between branches based on their contributions. Companies choose the method that best fits their situation and ensures compliance with tax rules. Tax authorities require companies to keep detailed documentation of their transfer pricing policies and transactions. This includes information on how prices were set, which methods were used, and why those methods were chosen. Good documentation helps companies defend their transfer pricing in case of an audit and shows that they are following the rules. Keeping records up to date is essential for avoiding fines and disputes. Tax authorities regularly audit companies to check if their transfer pricing is fair and follows the law. During an audit, officials review documentation, compare prices, and may ask for more information. If they find that transfer prices are not set correctly, companies can face penalties or be required to pay more tax. Being prepared with solid documentation and fair pricing policies is the best way to handle audits smoothly. Transfer pricing is a key part of tax planning for multinational companies. By setting fair and strategic transfer prices, companies can manage their global tax burden and ensure compliance with local laws. However, aggressive tax planning that manipulates transfer prices can lead to legal trouble and damage a company's reputation. The best approach is to balance tax efficiency with transparency and fairness. Organization for Economic Cooperation and Development (OECD) provides international guidelines for transfer pricing. These guidelines help countries create consistent rules and help companies understand what's expected. Most countries base their transfer pricing laws on the OECD's arm's length principle. Following these guidelines helps companies operate smoothly across borders and avoid double taxation. Many countries now require multinational companies to file country-by-country reports. These reports show how much income, profit, and tax a company has in each country. The goal is to increase transparency and help tax authorities spot potential transfer pricing issues. Accurate reporting is essential for compliance and helps build trust with regulators. In practice, transfer pricing involves cooperation between finance, tax, and business teams. Companies need to analyze their operations, choose the right pricing methods, and keep thorough records. Regular reviews and updates are important as business models and tax laws change. Good communication and teamwork help ensure that transfer pricing policies are effective and compliant. Transfer pricing can be challenging due to differences in tax laws, economic conditions, and available data across countries. Finding reliable market prices for unique products or services is often difficult. Companies must also keep up with changing regulations and increase scrutiny from tax authorities. Overcoming these challenges requires expertise, careful planning, and ongoing monitoring. Technology plays a growing role in transfer pricing. Advanced software helps companies analyze data, document transactions, and comply with regulations. Automation can reduce errors and save time, while data analytics provide insights for better decision-making. As tax authorities also use technology to review transfer pricing, staying up to date with digital tools is increasingly important. Tangible assets like patents, trademarks, and software are often transferred between related companies. Setting fair prices for these assets is complex because they may not have clear market values. Companies need to use specialized methods and documentation to justify their pricing. Intangibles are a focus area for tax authorities, so extra care is needed when handling these transactions. Transfer pricing also applies to services provided between related companies such as management, IT, or marketing support. Pricing these services fairly can be tricky, especially if there are no similar services in the market. Companies must document the nature of the services, the costs involved, and the method used to set the price. This ensures transparency and compliance. When related companies lend money to each other, they must set an interest rate that matches what independent parties would agree on. This is called an arm's length interest rate. Setting fair rates prevents profit shifting through artificially high or low interest charges. Proper documentation of loan terms and interest rates is essential for compliance. Royalties are payments for the use of intellectual property like patents or trademarks. When one branch pays royalties to another, the amount must be set at a fair market rate. This prevents companies from shifting profits by charging too much or too little. Accurate royalty pricing and documentation are key to staying compliant with tax laws. Transfer prices can also affect customs duties when goods cross borders. Customs authorities may review transfer prices to ensure that import duties are calculated correctly. Companies need to balance tax and customs requirements, as different authorities may have different views on what a fair price is. Good communication and documentation help manage these risks. Disputes can arise when tax authorities disagree with a company's transfer pricing. These disputes may lead to double taxation, where the same profit is taxed in two countries. Companies can resolve disputes through negotiation, arbitration, or mutual agreement procedures. Having strong documentation and following international guidelines helps prevent and resolve disputes. Advanced Pricing Agreement (APA) is a deal between a company and tax authorities on how transfer prices will be set for future transactions. APAs provide certainty and reduce the risk of disputes. They are especially useful for complex or high-value transactions. Applying for an APA requires detailed information and cooperation with tax authorities. Transfer pricing is a major concern for developing countries, as they rely on tax revenue from multinational companies. These countries may have fewer resources to enforce transfer pricing rules, making them vulnerable to profit shifting. International cooperation and capacity building are important to help developing countries protect their tax base and ensure fair taxation. Transfer pricing rules are constantly evolving. Recent trends include increased transparency, stricter documentation requirements, and more cooperation between tax authorities worldwide. Digitalization and the growth of intangible assets have also made transfer pricing more complex. Staying informed about new developments is essential for companies operating internationally. Base Erosion and Profit Shifting (BEPS) project led by the OECD aims to close gaps in international tax rules. BEPS includes measures to prevent companies from shifting profits to low-tax countries through transfer pricing. These measures require more transparency, better documentation, and stricter enforcement. Companies must adapt their transfer pricing policies to comply with BEPS requirements. To manage transfer pricing effectively, companies should follow best practices such as regular reviews, clear documentation, and ongoing training for staff. Staying up to date with international guidelines and local laws helps avoid problems. Good communication between departments and with tax authorities is also important for smooth operations and compliance. Summary: transfer pricing is a vital part of international business and tax planning. It ensures that profits are fairly allocated and that companies comply with tax laws in every country where they operate. By understanding the basics, following guidelines, and keeping good records, companies can manage transfer pricing effectively and avoid disputes. Staying informed and proactive is the key to success in this complex area.